Welcome to Striking Options, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and we've adjusted our show until we get back into the studio. And I'm joined today by Scott Barr. Welcome, Scotty.
Hey, Jeff, how are you?
I'm doing well. Interesting to see we had a big move higher in the equity markets. Subsequent, Fed Chairman Powell hitting the media outlets over the weekend. We continue to see him try to inject confidence into the market. But my question to you specifically today is that are we seeing a dislocated rally, or is this the new normal?
It appears to be the new normal, Jeff. It really does. And any one day, any week, we are going to see different headlines. And until we get back to that new, not just the new normal, but till things were how they used to be economically, things open up a little bit, we are going to continue to see this dislocation.
Well, fascinating to see. And let's peel back the onion a little bit here, Scott. The NASDAQ 100 is less than 4% away from its all-time highs. Conversely, the Russell 2000 is down about 20% year to date. So help me better understand, in the wake of COVID-19, are these smaller cap stocks really suffering on the potential damage we have seen economically?
The big thing here, Jeff, is with rates near zero and even some talk about negative rates. That is not good for the small caps. That is not good for the regional banks. And I think that is a big, what's really lending to this big dislocation that you're talking about.
I think you bring up a great point, and certainly that's allowing a concentration into the tech rally, into the FANG stocks we always talk about. But you bring up interest rates, and that leads me into the second topic. I want to talk about treasury yields, Scotty, and they really remain subdued. We've seen the 10-year note from a year-to-date perspective, the low yield during the panic we saw on the tape. You saw that 10-year note yield touch 31 basis points. Now we're seeing elevation back around 75 basis points. But my question, will we see the central bank intervention continue to keep pressure on these treasury yields, and will they remain under 1% in the 10-year?
It certainly seems like in the near future, that is the case here with Chairman Powell, really coming out and saying they will do anything that they can, it seems like, to support the market and flood the market and keep rates low. So yes, that certainly seems to be the what's here for the near term.
And I'm fascinated to see Fed Chairman Powell testimony today in conjunction with Secretary Mnuchin, but he's reiterating the fact that we don't foresee negative interest rates. So it's going to be interesting to see as the Treasury yield certainly is weighing upon the bank sector, but that Treasury yield should stay in somewhat of a proper curve, a steepness, if you will.
It absolutely should, but yet there is some skepticism. There is some thought process to at a minimum rates staying near zero, whether they turn negative or not.
Well, Scott, thanks as always. We want to thank you for tuning in to Striking Options, and please tune in every week as we'll continue to strike options.